You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Felix Vortsman, real estate investor with more than 12 years in investment and multifamily business in Ontario. Please help me to welcome our guest today. How are you, Felix?
I'm doing very well, Adam. Yourself?
Thanks so much for being with us today. And before we get deep on multifamily and commercial real estate, I would like to ask you about what was the beginning for you on commercial real estate and why commercial real estate?
Well, after investing in real estate actively for several years, I felt that, I employed several strategies across the board: student rentals, rent-to-own, and single-family homes, conversions, and the like. And eventually you pivot from one strategy to the next as they become more, I would say, what some strategies work better sometimes, but not all the times, right? So, for example, the market that I'm currently operating in, single-family home buying, you can no longer cash flow on these things. So I had to pivot over time, and eventually you reach a certain level of wealth and expertise where you basically want to keep on scaling up, right? Pivot higher, and eventually I basically came across, the private equity syndicated deals, both on the development side and the multifamily side. There's a reason why we do what we do as investors, and it's not to create a ton of more work for ourselves. We do want to basically create a nice nest egg. We want to make sure that, but the main reason why we do it is to win back our time so we can do what we want to do. So typically, you're not going to want to create more work for yourself, even although you can certainly do so. And I found that the private equity syndicated models really basically appealed to me from that perspective, because if I wanted to be active on these type of deals, I could be active. If I want to be passive on these deals, I can be passive. So I can pick and choose how much work I basically employ into these type of opportunities. And sometimes I decide to be in the passenger seat as a limited partner, for example, to be a purely passive investor. And at other times, if I want to basically level up my skills and be more active in deals, I'll participate in them as a co-general partner or both.
Oh, okay. So you've been, as you mentioned, you've been on the driver's seat or the back seat. So for now, as you see, there's a shift on the market, especially from the passive investing perspective, especially on the criteria and selecting operators. What is the upside for you right now when you're choosing an operator, when you are in the back seat, basically, or the passive investor? What you're looking for when you're choosing your operator or your deal?
For sure. So very important. And this applies to even, small investor joint venture deals. There's a lot of similarities involved. Number one, you're looking at track record, right? Have the operators been in business and have done these type of deals time and time again, and take a look at basically what they projected, the results that they were projecting versus the actual results. You're looking at, and this is at the nitty-gritty level, right? You're also looking to make sure that they have good teams in place that can execute on the results. On the top level view, like on the 10,000 floor view, when you're looking at things like location, you're looking at increasing population flows, you're looking at good paying jobs, you're looking at highly diversified economic bases within those municipalities. So all of that plays into the equation. And finally, you're looking at, on the micro level, the neighborhood levels. You're looking at the dynamics at play there. You're looking at, the percentage of what jobs the tenants are working in, for example. You don't want any one industry to be making up the vast majority of the employment opportunities in those areas, because if that company goes belly up, so does your investment in a lot of cases. So there's a lot of things to take into consideration, and then it comes down to a deal by deal basis, right? What I've found is every single deal is structured very differently and underwritten very differently, right? I tend to be, people look at me as a real estate investor and they think that I'm a very high risk individual, and that's the furthest thing from the truth. I'm actually a pretty risk averse individual.
Mm.
So, I have a set of criteria that I like to follow. I assess every single deal, right? Cash flow is king. So first and foremost, that opportunity needs to pump out cash flow,
Mm.
either immediately from day one or shortly thereafter, right? I'm looking at the demographics. I'm looking at the occupancy rates. I'm looking at the condition of the properties. What does it take to basically renovate them? Do a smell test to make sure that this makes sense. That the budgets that my general partners are basically providing to me are reasonable, and I could do so because I've done several projects myself at smaller scales maybe, but I know approximately what the construction costs are. So I can usually do, a very simple analysis to see if this makes kind of sense or whether the general partners are totally out to lunch.
So,
Um,
as a passive investor, as you mentioned, this is basically the market fundamentals and the team experience. But when you're investing and you're trying to diversify between your investments, what is appealing for you more between REITs, funds, and syndication, which is the regular deal by deal basis? Why you're going with always the syndication model more than the REITs and the
okay,
fund model?
excellent question. And I think most people are familiar with REITs,
Mm.
especially publicly traded REITs.
Mm.
Um, let's define it very briefly. And to a lesser extent, the fund structure is technically a private REIT, right? It
Correct.
might be smaller,
Yeah.
right? And then you have the GPLP structure. Now, there's pros and cons to each one of these strategies. The reason why I like the GPLP structure in the syndicated model is because it offers you the highest return possible
Correct.
out of all of them,
Mm.
because you're running very lean. If you're dealing with REITs, you need a CEO, a CFO, all the admin staff, regulatory reporting. So basically, a lot of the profits and cash flow that you're generating from these real estate portfolio is being sucked out by these individuals or these processes, right?
Correct.
To a lesser extent, I mean, the same thing applies in the fund structure, in the private fund structure or private REIT sector. You still have to have that overhead involved, right? Um,
The management fee.
the other, was that?
The management fee. Like
There's a
more like,
management fees and
yeah.
everything else as well,
Yeah.
right? And again, not all of them are created equal. I mean, if people are interested in investing in REITs or even fund structures, you have to do your due diligence because each one
Mm.
of these deals is structured very differently.
Yeah.
On the GPLP structure, I mean, the other thing is when you're investing in REITs and fund structures, you're investing in the good and potentially all the bad and the ugly within that fund.
Correct.
So it usually consists of like several properties in there. Some of them might be, superstars. Other ones might be underperforming. But when you're investing in it, you're investing in the whole basket. You don't get to pick and choose. I kind of like the GPLP structure because number one, it's very lean in operations. The people who are managing the deal, the general partners, and also your ability to pick and choose which properties you want to participate in. So if something smells bad and you don't like that specific investment, move on to the next one. You don't have to basically invest in that property. So you could pick and choose and thereby de-risk or mitigate your risks of investment risk and maximize your cash flow. The other benefit about investing in a GPLP structure is, especially if they're structured properly. And again, I cannot underscore this enough. You have to do your proper due diligence because not all of them are created equal. Is you want to basically invest in GPLP structures where number one, your GPs are also have some skin in the game, preferably considerable ones. I've seen a lot of deals where the GPs put zero money down of their own. To me, right off the bat, that basically sets up red flags. And in addition to that,
I think unlikely if you're gonna find something like this there's no skin in the game, you're not gonna invest because it shows that there's no actual confidence on the deal itself.
Correct. And a lot of these people have never done a deal like this, like a multifamily deal. They're newbies essentially, and they're trying to source other people's money, but without having that track record, which is, to me, is insane if you want to invest with those types of individuals, right? It makes no sense whatsoever. But the GPLP structure works really well, especially if you, after your due diligence, you recognize that the how should I put it? The motivation of the general partners are fully aligned with the success of the limited partners, the passive investors.
Yeah.
And what I mean by that is, general partners typically don't make very little of fundraising necessarily, right? But as far as the execution, that's basically the vast majority of where they can make their money.
Correct.
But they can only make that money if they execute and deliver on the results that they promise to limited partners. And the better that the limited partners do, the better that the general partners do. So their interests are 100% aligned in the best case scenario. That's essentially where you want to be. I've seen a lot of deals where that's not the case. I've seen both the fund structure, REITs, or even GPLP deals where, again, money is being siphoned off by the general partners, right? Every time they do, I'll give you an example. Let's say they do a refi on the property after they reposition it, right?
Which is the regular time frame between 4 to 6 years.
Correct. Or a sale of the property.
Yes.
Some of these guys might take 10, 20% off of the overall value of that capital transaction. And I know some private REITs that do that, right? But they don't disclose it very well. So they might offer like an 8% yield as an example, but the actual return is much higher. But the reason why it's so low is because they're taking a big chunk of the profits for themselves.
Right? At the end, as you mentioned, because one of the things on multifamily usually is upfront fee, which is acquisition fee is not too much, but when you're doing a refinance or actual exiting the deal, this is where the money come from. And you're referring to the split between the GPLP, whereas usual split is 30 to 70 or 20 to 80.
Correct. And it could be higher, lower, depending on the nature, how much work is required. Like if a property needs major renovations and will require a ton of time of the general partners, that split, that's actually an important point as well. There's reasons why some splits are more robust than others.
Yes.
But then again, basically the split is lower. Typically the expected profits are higher as well. Yeah. Right. And it's given the amount of work that the general partners need to put into the deal. Right. If they need to reposition every single unit out there, deal with evictions, major renovations all across the board, and they'll need 2-3 years of full-time work without getting almost paid at all. Clearly, I mean, you want to make sure that your general partners are getting some sort of benefit. Otherwise, what's the point for them to do it, right?
And this is basically the different split or waterfalls. When you're splitting the deal between the GP and LP, you have different hurdles and waterfalls between as GP and LP.
Correct. And people sometimes structure, like I said, these are very, every deal is structured very differently depending on which organization you deal with, depending on which general partners you deal with. So I cannot underscore this enough. You have to do very good and proper due diligence and ask those relevant questions of the general partners to see exactly how these deals are structured. The other thing is, I mean, they can play around with numbers. I only like to deal with deals that tend to be very conservative in nature as far as their underwriting is concerned, right? Sometimes the more liberal general partners like to embed like appreciation rates as part of the overall return, or they'll basically create some, let's say rental rates over the last year went up by 15%. So they're assuming that they're going to go up by 15% for the next 5-6 years, which is unreasonable as well.
Yes.
Right. So, or cap rates, they're thinking the cap rates are going to compress even further. Right. So these are very liberties that some general partners take that don't make any sense, because the reality is nobody knows what the future holds in the next 12 months, let alone 5-6 years. So I prefer to deal on the more conservative basis with deals that are underwritten more conservatively. So deals that we're actually, like in the current deal that we just closed on, we're actually embedding or assuming that the cap rates are actually going to rise. Yes. And when the cap rates rise, actually the real estate values actually go down. Yeah. Right. The rental raise that we've experienced year over year just before buying the property was about 12.3%. We are only tracking 3 to 4% rental rate appreciation on an annual basis, right? So that's overly conservative, and as a result, I mean, our deal might not look as attractive as some of the other players out there, but we are very comfortable that we can deliver on these results, right?
I think the lesson here is when you're investing, especially on the passive side, you need to, especially on the syndication part and commercial real estate, you have to have some minimum information about how you evaluate the actual deal, including the technical part, which is we're talking about underwriting, about market fundamentals. And this is basically what you did on the last 10, 12 years. You started to understand actually how to be conservative. You're just not uh, follow the flow with going with one of the syndicators or the operator just with the name or the track of record, but also you are analyzing the actual performance and the deals uh, based on the actual fundamental on this deal, which I like about what you're saying, because you're not just asking about who's the highest return on the market. No, you're actually doing your due diligence, and due diligence here are not only on the legal side, but also on the financial and the economical side, which this is basically what we name it as a professional passive investor.
Correct. And the other important thing, obviously, is you want to make sure you're dealing in deals that have plan A's, B's, and C's with respect to either the exit of strategy or ensuring maximizing of cash flow. Right. So, some of these deals are structured by, we need to sell within 3 years. Well, what happens if the market conditions are not warranted, for example, right? What if the rental rates have not increased as high as you wanted them to be, right? You have to take a lot of this stuff into consideration. What I find some of the deals that, come across my desk, some of the general partners don't consider any of these type of dynamics at play, right? So they might look like sexy returns up front, and they might look like higher returns than some of the deals I operate in, although they are very robust returns regardless. But I'd rather stick to, be on the safe side effectively. And lastly, if you're starting to deal with a new operator, clearly, if you know these individuals, you've seen their track record for several years, perhaps you can jump in with 2 feet, but I like to spread my eggs. I don't keep all my eggs in one basket, right? I like to, if I want to dip my toe with a new general partner as a passive investor, if I would choose to be a passive investor, I might basically invest maybe a minimum investment amount and basically see how that plays out. If that works out well, it gives me like experience dealing with these individuals, see exactly what kind of communication is coming from them, looking at their execution. And when I say communication, it doesn't mean just all rosy stuff, like, everybody expects everything to go well. At the end of the day, you're dealing in real estate. Stuff comes up, but you want to make sure that you're getting excellent communication from your general partners, the good, the bad, and the ugly, because they need to provide you with what the heck is happening with the property instead of trying to sugarcoat something about it. And I respect general partners like that. Then you can, of course, assess basically whether the issue pertained to a general partner issue, maybe they're not executing well, or whether there was something outside of their control, right? And that gives you, like, you get your feet wet with those general partners and you see how they operate. So the next deal that they basically do, if I feel fully confident with my management team, I might invest even more with them, right? So there's different ways to go around doing it. It really depends on what your risk appetite is, but the due diligence component is imperative. And as I mentioned, none of these deals are created equal. And depending on how these deals are underwritten by the general partners is of paramount importance when you're comparing, because you want to compare apples to apples.
Agree. So the main thing here about you is you're jumping to the states markets, coming from Ontario and Canada's market. What was the motivation for you to jump to especially like unknown markets for you, like Arizona, Phoenix, or Atlanta? As a Canadian, what is the potential you see on this market versus, for example, Ontario market?
For sure. And that's an excellent question. Well, I find that the barriers of entry in the Ontario market, especially in the areas that I like to invest in, have gone very excessive. Trying to get cash flow out of our markets these days is becoming very tough. So when you're dealing in the Ontario market, the cost of capital just to buy the house, the cost of capital just to do like a 2 or 3 unit conversion, you're looking at around $400,000 or $500,000. And for a newbie investor or for a lot of investors, that's a lot of capital to deploy.
Yeah.
Right. There was a time where everything was less expensive. Everything kind of made sense. Right now, it's getting tougher to achieve that positive cash flow, which I'm targeting at all times, because positive cash flow is your insurance policy to anything that happens in the market. And what I found is that I explored other markets such as Alberta, the east coast of Canada. You could make the numbers work there, but when you're taking a look at the US, you could deal with municipalities there or general areas that are even significantly larger than Toronto and pick up properties there for significantly less than what you can pick them up here. They're cash flow positive in a lot of respects from day one if you're dealing on the multifamily side. And that's even before you do any renovations, right? Or any
In
rehab.
general, it's a fraction of price. Like if even we're talking about main municipalities or like metropolitan, like Atlanta, talking about 150 to 170 a unit. We're in Canada, we're talking about, or Ontario, we're talking about 400 to 500 a door. So yeah, for sure, the entry price is really different, even with main cities or states like Georgia, Texas, Florida. So I agree on this point.
And excellent, all excellent points. The other thing to take into consideration is Ontario is no longer landlord friendly. It never was, but now, like with all the delays in the landlord tenant board, like I've actually had to execute an eviction actually last week. It wasn't pretty. It took me 15 months to get a tenant out, which is insane.
Yeah.
And they owe me
money
about
for 15 months.
Yeah, and I mean, they owe me over $15,000, and that's even before basically all the renovations I'm going to have to do and the junk removal and all the other stuff.
Yeah.
So it's becoming a pretty risky market to be in, albeit it is still amongst the best. It has amongst the best dynamics in all of North America. So I'm not discounting it fully, and you could still achieve, employ certain tactics and certain strategies within the Ontario market. But like I said, the cost of capital and the risk, several risk factors that you have to now take into consideration, does not make it as appealing as it once was.
I think the main problem with the Ontario, beside of that, is scalability. If you're trying to scale your business, Ontario is not the market for you, because the game on this fringe market like San Francisco, New York, Washington, Toronto is appreciation, not a cash flow market. And that's why the cap rate here, and it's really about 2.2, 2.3, whereas other market in the States, almost most of the market, you're talking about minimum 4.5 on big market like Dallas or Georgia, Atlanta. Whereas as I mentioned, Hamilton even is 3% and 3.5% cap rate, which is really hard to have any spread between your cap rate and the interest rate. And this is one of the main point, I think, to any investor want to understand the difference between the US and Canada, is that you have to look on the deals based on your spread between the interest rate you're getting in and the cap rate, which is, I think, it's the most important factor to have a cash flow, to have a really decent risk-free deal.
Absolutely, and for that very reason, the numbers no longer make sense. I mean, like if you're looking, and when you're looking at like a major city like Toronto, like if you're looking at the pre-construction pricing, for example, even a 600 square foot condo is going to cost anywhere between $1,700 to $2,400 a square foot.
Yeah.
At the prevailing interest rates, you're looking, even if you put 20% down, you're looking at a carrying cost of $6,000 to $7,000 a month.
Yeah.
On something like that. And what are you going to get in rent? $3,500 now. So what investor in their right mind would want to basically invest in something like that where they're bleeding cash every month? It doesn't make any sense.
The confusion coming from, I think, new immigrants or new investors to the market, when it was really shining on the last 5 years, how much appreciation they got on this deal, especially on condominium, and they prefer, or they think this is a better thing to do. I can double my money in just 3 years, but they don't understand that the market cycle is not always like this, and you cannot rely on this. And in downturn market, it's easily you can lose your whole asset, because you're not going to able to maintain this high interest and the loss on the appreciation you were thinking that this is going to be my end game. So I think this is coming. This is coming from newbies on investing on in multifamily or even single family home in general.
Yep. And you bring up a good point. Like major cities like New York, like the high flying real estate markets like New York, Toronto now. Toronto has come to its own only in the last 10 years.
Yeah.
Prior to that, I mean, you could find affordable options in the GTA, but that is no longer the case, whether you're a renter or a buyer. And even San Francisco, what people don't seem to understand is, what does it take to move a needle on $1 million property versus $150,000 or $200,000 property?
Yeah.
Right. People don't seem to recognize that people's budgets are usually pretty darn static. Right. Nobody can just, if you're a renter or a home buyer, you can't just snap your fingers and saying, well, I now have to make $250,000. I'm only making $60,000, $80,000 today. I haven't, go to your boss and say, I need to make $250,000 in order to afford to live in the city. It's not going to happen. The boss is not going to give him a raise.
Yeah.
Right. And that will have an impact with respect to appreciation in these specific markets. Now, appreciation to me, unfortunately, people who bank on appreciation, I don't call them investors, I call them speculators. Right. Right. And if you're looking at high-flying markets, that's essentially, and most buyers who are buying in these markets, they're not doing it for cash flow any longer. They're looking at it exclusively for appreciation. And the problem is, appreciation is like a bonus, right? Like you're working for someone, you get your salary every couple of weeks. You come into work, you get a salary every couple of weeks. What is the analogy to that in the real estate market? Well, your principal pay down on your mortgage, right? And your cash flow is your salary, right? So what is this concept of appreciation? Appreciation is your year-end bonus, right? So if I had to ask you, Adam, it's like, do you know what your bonus is going to be this year, Adam? Or do you even know whether you're going to get one?
Speculations.
It's speculation, right? Yeah, but a lot of the speculators think that, that's the deal that they're making. It's as if like I'm going up to them and saying, by the way, this compensation package you had before of hourly wage and year-end bonus? Okay, the hourly wage or your salary is poof gone. You're now going to be compensated based on an appreciation only. Deal? And you don't know whether, and your question would be like, how much am I going to make? I'm like going, I don't know. You could be the best employee in the company, but if the company does crap, you get nothing.
I think that the market has been driven by false information by especially real estate realtors trying to get more money from like having this mindset on, as you mentioned, on the speculators, not the investors in the market, which is drove the market crazy. And right now is the downturn, or what we have right now in the recession, is going to have some sort of more acceptable and rational jumps on the market, at least on the next 4 or 5 years, which this is basically what we hear about, is how you can understand investing professionally on multifamily real estate in general, because this is not a speculation game, not only appreciation. The main, I think, that the whole industry driven by the concept of the cash flow. Okay, thanks so much for being with us today. And my final question to you will be, how the people can follow your success?
For sure. They can either email me or reach out to me on Facebook or LinkedIn. I post a lot of insights on the market, both in the US and in Canada. Or they can reach out to me by email at felix@cloud, CLOUD, the number 9, life, LIFE.ca. I'll be more than happy to provide them with any insights that they're looking for, both whether they're interested in multifamily investing, private equity investing with respect to development deals, why I do it, why I think that these are great opportunities, especially moving forward, all that good stuff, for sure.
Appreciate it, Felix. Have a good day.
Thank you so much for having me, Adam.
Thank you.